before I started trading floor research, I was a portfolio manager for Stifel Financial for 17 years. And I've spent a total of 33 years managing portfolios. First, as a financial advisor at A.G. Edwards in downtown Chicago. So today, what I plan on doing is covering a subject that, quite honestly, is not very exciting and not very glamorous, as far as the trading business goes. Therefore, you probably don't hear a lot of presentations on risk management. But I think it's an essential topic. When I look at what we have done as far as the market in the first 6 months of this year, where we, this is the worst 6 months since 1970. Just a horrendous start. And that just says to me that the topic that we're going to be talking about today it just makes a lot of sense. And what I'm going to be doing is I'm going to be talking about risk management from a portfolio manager's point of view. The same risk management rules I used as a portfolio manager are the same rules that I use daily as I advise subscribers to trading floor research. And so the idea here is what I'm doing, and I'm going to show you as we move along here. What I like to do is I try to simplify this risk management process for the subscribers. So you don't have to get caught up in all the work that I'm doing. I simplify a lot of the process. And so we're going to talk about that today too. So let's get started here with this topic again of risk management. And the first thing, let's go through some of the areas we're going to cover today. Number one, what we're going to cover and kind of what's the overview, just like, I don't know if any of you attended the webinar I did a few weeks ago, but the overview of what I talked about then was what makes a stock move. And at that point, I talked more about what makes a stock move from the standpoint of what makes it move higher. It just so happens that the same rules that make a stock move higher are the same rules that are going to make a stock move lower. And the idea here is first of all, to what we're going to try to do is establish those rules and understand that what we're doing is analyzing now from the factors that I've used what makes a stock actually move lower. Then what we're going to talk about, that should be point number 2 actually, but next point we're going to talk about is drawdowns and the reason for disciplined selling. And then we're going to be talking about cutting losses, disciplined selling. And then this is where we're going to go. We're going to veer off and talk about position size and portfolio allocation. Very, very important part of risk management. And finally, I'm going to put it together with an example in the end using technical analysis in strategies to cut losses. But along with that is part of risk management too, as we're going to be talking about here, is buying at what I call low risk entry and how to get that low risk entry and establish a better entry for your trade. So all of this to me is areas of risk management, and we're going to try to cover it hopefully in the next 45 minutes. We're going to start here with the 3 points, like I did in my last presentation of what makes a stock move. But again, this time we're going to talk about it in a sense of what makes the stock move lower. And number one is profits, it's earnings. In this particular case, though, instead of earnings acceleration, it's earnings deceleration, earnings compression, which as we're now moving into, we just closed out the second quarter. Of course, in the next weeks to come, we're going to be really moving heavy into earnings season again, where we're going to start hearing a lot of these earnings reports. And in these earnings reports, what I plan on hearing a lot of is earnings deceleration. I expect to hear that. And so we're going to kind of cover that and what that really means for the stock price itself, because again, what moves the stock? It's going to be earnings. The next area, what moves a stock, number two, is the industry group. A lot of people don't realize this, but 60% of an individual stock's movement is based on the industry group. And so in this case, though, what we're going to be looking at is how the industry group should be looked at in risk management of the overall portfolio. When the industry group gives you a sell signal, what does that mean for your portfolio allocation? What does that mean for buying that individual stock? Where do we go with all of that? And that's the risk management part of the equation on that. The third point is what moves a stock? Volume. And again, where's that volume coming from? It's coming from big institutional money, mutual funds, hedge funds, banks, pensions, insurance companies, family offices. All these areas are sources of big money. And what we're looking at, though, in terms of what makes the stock move lower, is not the accumulation of the shares. It's the added supply to the market of the shares, or the distribution of shares by these institutions. And that's what we're going to look at in risk management is, first of all, how to see that coming. Where's it coming from? And then what do we do about it? So let's get started here with earnings deceleration. And the example I'm going to use for this is Meta Platforms, which of course everyone knows used to be called Facebook. They just recently changed their name. But what I want to look at, though, is the idea that if you see, as the stock was moving higher in price, 93% quarter over quarter was the first quarter earnings reported of last year. And we still were accelerating into the second quarter of last year. So in other words, we weren't just good earnings, they were earnings that were getting better, going from 93 to 101%. But then all of a sudden, what started to happen with these stocks, and then how was this reflected in price? So then what we started seeing is earnings deceleration. We started going from 101% quarter over quarter to up 34% quarter over quarter. And it doesn't sound like a big deal because the earnings are still pretty good. They're still very good. But when you bid these prices up like they were bid up, any sort of deceleration like this is going to cause this kind of an effect. And then what do we see in the next quarter? Now the earnings were actually even lower than the previous quarter. So now deceleration has taken us minus 5%. They're still positive, but they're lower. We went from 388 down to 367. And then what do we do in deceleration in the next quarter or last quarter's earnings, the first quarter of the year? It decelerates even more, minus 18%, 330 to 272. Now, again, we can easily see this deceleration causes a stock to move lower, as well as earnings acceleration causes it to move higher. The big problem with this, though, is, and I don't know if you saw this in the chart, but you can see this in most charts, the biggest problem with this is that it's not giving you any advance warning. It's not, even though it is what moves a stock, when stocks are topping out, this is not what gives you the edge. As a matter of fact, if you noticed, before we got the first earnings deceleration, price had already topped out and started rolling over. And this is a big part of why, as a portfolio manager, as a manager that was constantly forced to focus on risk management and the risk to these shares, where I turned to and where my expertise really went to was to the technical side. And that expertise got so much that not only do I do trading floor research now, but I actually even advise, I consult still to this day, many portfolio managers in Chicago. I consult them with their fundamental positions because one of the big things that really portfolio managers, and I should say this, yeah, one of the biggest things that portfolio managers really have a problem with is achieving consistent returns. This is a major problem, and I'm going to tell you why I feel that portfolio managers have this kind of a problem and how I rectified the problem, of course, for myself, but I also think that being a consultant to a lot of portfolio managers now is helping achieve more consistent returns because they're not asking two very important questions. What 99% of portfolio managers and analysts ask is the first question: what? What great stock are they buying? And that question is answered through fundamental analysis. What great company, I should say, are they buying? And that is a total fundamental question. And again, that question is, for me, that question was answered mostly through PEG ratios and earnings acceleration. And again, I was focused more on PEGs because I wanted to buy GARP stocks or growth stocks at a reasonable price. And that what question was answered a lot through those kind of metrics for me. But the question that a lot of portfolio managers don't know how to ask is the when question. And the only way to answer the when question is by using technical analysis. And again, this is the part of the equation also why I bring it up in this topic, is because this is really how you're going to address risk management also. If you're not answering that when question, you're going to have a very, very tough time with really adjusting the risk of your portfolio in a proper way, especially in these kind of markets. So here's the thing: if you don't know why you bought a stock at a certain price, how do you know when to sell it? And what you find is you find a lot of these portfolio managers, because they don't know why they bought it at that particular price, as stocks are declining, they're viewing it as an opportunity to buy more shares. And again, this is why you're getting inconsistent returns. This is why you're getting a lot of people that are really blowing up in this market right now. It is got to be an understanding of, look, there is a certain point that you get out of this stock. And then there is a point, now we talked about that in the last webinar that I had, the point of the entry point for myself, my early entry system. And we're going to talk just a tad bit about that today, but we're really not going to focus on that. We're going to use that system more today to focus on when you should be selling this stock. And that's the whole thing. Stock price is a measure of supply and demand. The greater the supply coming in, this is a force you just can't go up against. Okay, here's an example too, just a quick example of again that inconsistent return that's going to happen because you're focused on just the what part of the equation. So when I was a portfolio manager, I would get these reports. This was our analyst. This was from our analyst, and this was a report that I got from our analyst on Kraft Heinz Company. Of course, this was right after Kraft merged with Heinz. So Kraft Foods out of Northfield, Illinois, just north of Chicago, merged with Heinz Company out of Pittsburgh, Pennsylvania. And both of them came together. The analyst did an extensive report. This was only page one of it. The bottom line of the report is it was a buy, but not only was it a buy, it was on his select list of buys, meaning this was his best buy of the year. And he put that report out. The stock was trading right about in this area. Because he doesn't answer both part of the equation, and because a lot of portfolio managers don't, they buy this great what and don't recognize that it's not the proper when. And what we're going to actually talk about here, and there's your first clue right here. What I talked about in my last webinar, in my 5 factors that I purchased industry groups and I purchased individual stocks, was one of the factors. The first one was price analysis. And that price analysis, we're going to cover a little further here today too, but that price analysis dealt with this idea of Don Sheehan's 4-week rule. So in other words, Don Sheehan's rule says if price makes a new high, it becomes a buy signal. And it's a pretty basic rule, but what I did to enhance that rule was not only did I add other factors to it, but what I also did was I said, I wanted to see price close at a 20-day closing high, among other things. Well, on the opposite side of things, I don't look for price to just hit a 20-day closing low to give a sell signal, but price, when it closes as it did on this day right here, when it closes at a 20-day closing low, I don't care if this company just announced the cure for cancer. I don't care what was said, the greatest news in the world. If this stock is closing at a 20-day closing low, hands down, I sell immediately. That is my drop dead risk management to the max. That is my sell signal that I'm going to take. And as you can see, once it did that, it immediately started to go into a downtrend. By the way, over in this area, it hit a 20-day low, but again, it didn't close at a 20-day low. So again, this stock was not a sell at that point. That's a key factor. Not only is it a key factor on the plus side, it's a key factor on the downside. So this is where the stock actually just gave its sell signal. And again, this is the first area we're addressing here. We're going to talk more about this, but for me, that is a drop dead sell signal. Now, the whole idea here, though, is when we're talking about risk management, as a trader, drawdowns, understand that. I mean, drawdowns cannot be avoided. This risk management is not about avoiding drawdowns. That's going to happen. That's all part of the process, okay? The whole idea here, though, is that it's controlling those drawdowns by disciplined selling is what's going to make the difference. That is what risk management is all about. And how do we get that disciplined selling? It's rules take emotion out of the trade. It's following our rules. And as a portfolio manager, when I started, I had to lay down in front of a panel of people at the firm. I had to lay down every single one of my rules. And it was a great thing too, because then I also had people looking over my shoulder, making sure I was following those rules. What a great thing, because that is what led to great discipline, is just don't make the rules, follow the rules. Look over your trades after this past 6 months or this past quarter. Take a look at your trades. Are you following if you do have exit rules that are risk management rules, are you following those rules? Because again, that's what's going to make all the difference. Now, here's where I'm going to pick on portfolio managers a little bit more. I have CNBC and Fox Business going all day long in my office as I'm sitting here and kind of in the background. But if I could count the many times I have heard in the background noise a portfolio manager saying in the last 6 months, it's not timing the market, it is time in the market. That is just, first of all, I think it's a cop-out. But number two, I think the problem with that form of investment logic is the biggest problem with it, and again, I'm just going to stick to the numbers here, is that market returns are asymmetric. And this is, again, one big argument why this whole idea, it's not timing the market, it's time in the market. This is a big reason why you're getting these inconsistent returns, because I don't know if they really believe it, or if again, it's just an excuse because they don't know how to get a person out of a bad position. In 2008, when I was a portfolio manager in some of those big market declines, I used my strategies, the ones I'm talking about today, in getting out of stocks. I actually spent just about the entire year of 2008 in cash. The only time I entered into the market was in November. I got some buy signals in November and I made a little bit of money. And I actually ended up in 2008, I actually ended up making 6.25% that year, only because I spent 10 months in cash. It wasn't time in the market. It was actually time out of the market that made the money. And the reason I bring that up even now is because even this, in my newsletter, I have been pounding the table since the beginning of this year. I've been pounding the table saying, for all the different reasons, all the risk management reasons, I've been saying cash and caution. You can look over my past newsletters. That's all I've been saying is cash and caution, and trying to instruct people to keep high levels of cash. And again, the biggest problem with this form of investment logic and why cash is so important when we're going through this type of idea is because of the asymmetric returns of the market. And what do I mean by that? Let's use the NASDAQ as an example. So when we hit the June 16 lows, the NASDAQ was actually down 34% from its high, from its November high. If you put $100,000 in the NASDAQ at that time, on June 16, that 100,000 would be worth $66,000. Now, that doesn't mean that to get back to 100,000, that doesn't mean you've got to return 34%. It means you've got to go up 51.5% to even get back to your original 100,000. And by the way, it only gets worse. If the NASDAQ, which I believe myself, there's a good probability the NASDAQ by the fall of this year, we could be down closer to 50% in the NASDAQ. And if that is the case, it will take 100% to get back even. And just these asymmetric returns of the market should be cause enough to be focused on risk management and moving to cash when cash is a better alternative, and also recognizing the idea that you don't even have a choice this past 6 months. And by the way, I had this in my newsletter also about bonds. I actually had bonds topping out and called it a major top way back in the beginning of 2021. When 10-year was still at 0.95. and I called it a major top in bonds. I went through that review again at the beginning of this year and said, look, we're still heading lower here on bonds. And so guess what? Bonds are down 20% for the year. So this whole idea that you can diversify away your risk is again a fallacy. And I got news for you. As the market moves into, like we actually just saw a couple of weeks ago, was really kind of a mini crash type of scenario. What happens in these type of scenarios is that assets actually even become more correlated. They start moving in total sync with each other. And we even saw at that point, energy was starting to participate. And I'm going to talk about that in just a little bit. But the idea here is that, again, it's about risk management, and that risk management should be taking you to cash in markets like that. And that's really what I try to emphasize in my newsletter too. Here's the other thing, one more thing I'm going to pick on portfolio managers is this. Here's two quotes again that I hear so often, and they are, when you sell, you must make two decisions: when to sell and when to buy. And when you sell, you must be right twice. So again, to me, bad excuses for a portfolio manager not doing their job. And I'm going to go a step further with this. It's what I feel about this and what I felt as a portfolio manager, and how I even feel today in advising and trading for research, is when you're selling, it gives you an opportunity. It's not an extra challenge like this, these two quotes seem to indicate. It's actually an opportunity. And why is that? Because typically when you get to a bottom of any type of market, and when you're selling off, market leadership is changing. And I'm even going to talk today about some new market leadership that actually is popping up right now. And what's interesting is the old leaders, which we knew the last of the ones that were holding this market up and taking us into the end of the year, were your Apples, Googles, Netflix. Netflix kind of topped out a little bit before that. We're going to show that in just a little bit. But Facebook and areas like that, those were the last of your leadership stocks. And guess what? There is no guarantee at the end of this thing that those are going to be the leaders coming out on the other side. And actually, history tells you that most of the time, it is new leadership stocks that are going to take off at the other side. So why try to average down in old leaders? Why try to use bad risk management techniques instead of, if it's giving you a sell signal, if it's telling you to get out, then get out and have that money ready for the next opportunity that actually is out there. And that's what risk management is all about. So last time, in the last webinar I gave, I talked about this early entry industry group system that I came up with and the 5 factors of that system. What that system really means to us today when we're talking about laggards of industry groups, and we're talking about looking at what causes an industry group, what are we looking at when an industry group is indicating that it's giving us a sell signal, when we should be using risk management and covering our positions in a bad industry group, are that really, I just look at the first 2 factors of that process. And the first factor, again, we've already kind of reviewed this a little bit, is Donchian's 4-week rule, but it's in reverse. Instead of a 20-day closing high, I'm now looking at a 20-day closing low. The second factor is incorporating what makes a stock move, again, is volume. And I'm going to show you how I incorporate volume on the downside, because again, what we're talking about more on the downside is we're talking about distribution here. And so I'm going to have an example right now of Netflix. And again, when we look at Netflix was beautiful. This thing was just rallying all the way up, all the way up, all the way up. We were going straight up here until what happened? We get a 20-day closing low on November 30th of last year, close to the end of the year. Since we got that 20-day closing low, we have yet to see a 20-day closing high. But more importantly, what puts an exclamation point behind that 20-day closing low, and what will send me to the sidelines, is the addition of adding volume into that equation. And so what I like to use is this idea of what's called an up-down volume ratio. I'm always referring to this in my newsletter, is this up-down volume ratio. And what that is, I just kind of gave a quick little definition down here. How you compute that is, what you're doing is you're taking over actually the definition says over a 50-day period of time and 50 trading days, and that's what I actually use. And again, why I'm using 50 days is because when the distribution or accumulation process is happening in stocks, it is happening over a period of time. When institutions are buying and when they're selling, most of the time, it's going to happen over a period of time. So how this is calculated is, what you're doing is you're computing the total stocks volume on days when it closes up, and you're dividing that by the volume on days that the stock trades lower or it closes lower. So what am I saying by that? I'm saying, okay, in the last 50 days, if we had 1 million shares that were traded with positive volume, okay, we had volume on the upside, and we had, or that was the volume on the upside, is say 1 million shares volume on the upside. And then obviously this is a pretty small stock, but we're just using this for an example purposes, and saying on the downside, we traded 500,000 shares over that million, or over that 550 day period of time. So if we take 1 million and divide it by 500, that's going to give us 2. That is strong accumulation. As a matter of fact, on Netflix, when it was running large, it was up at about 2.5. That is really strong upside volume at that point, okay? But if we say 1 million shares traded positive and 1 million shares traded negative, that gives us 1, which would be neutral. And that really is just the neutral point that's neither accumulation nor distribution. But then let's say we traded 500,000 on the upside and traded 1 million on the downside. Of course, that would give us 0.5, which, by the way, is about where Netflix is right now. That is massive distribution going on right now. So what happens as we're getting this, on November 30th, we got a 20-day closing low. What's happening around that 20-day closing low? First of all, the up-down volume ratio on November 2nd gave us a 20-day closing low. So this is our first warning right here. When I see massive accumulation and it's breaking down into distribution, now we're starting to see distribution. And then only a couple of weeks later, a few weeks later, we actually get a sell signal. And then 2 weeks after that, we actually go to distribution on the up-down volume ratio. It drops below 1. This is all pointing to, this is, again, for me, risk management. This is my bottom line. I am out. I am out. The market is telling you to be out. What I find interesting is when we gap down on this earnings report, how many portfolio managers I heard saying, what a great value on Netflix. I'm buying Netflix. And of course, you see a little pop-up because that was the general feeling right there. By the way, the pop-up really took you only up to the 20-day moving average. And another thing that you're going to notice here, just a quick little note, just these little tidbits of things that I've learned along the way. When you get a gap down in a stock, like you see this gap down in Netflix, this was a major gap down. Oftentimes, you will try to fill in halfway of that gap, even in the weakest of stocks. And actually, it oftentimes will even turn into a pretty good shorting opportunity. But Anyway, that's just, that's market behavior, came nowhere near a buy signal. But again, this is bottom fishing all the way down. The next earnings, not so aggressive buying anymore, but you still heard the chants. Well, you should be buying, you should be buying. And again, this is a bad risk management policy used by fundamental analysts and fundamental portfolio managers that do not look at when. And this is not going to turn into a when until my 5 factors of buy signal actually, and that's what again, I talked more about that in the last webinar, but my 5 factors of a buy signal. And I have to tell you, this could drag on for years, even if it doesn't go any lower, which I think it will. But even if it doesn't go any lower, this could end up going sideways for years. And again, it points to the idea that selling these things frees you up for new market leadership when it emerges on the other side of this thing. And there's a good chance that Netflix is not going to be a market leader at that point. So now, let's move back to these what makes a stock move list. And in that list, again, the second and third are industry group, again, 60% of an individual stock's movement. How do I judge that industry group? Well, I'm looking at that Donchian 4-week rule, 20-day closing low in this particular case, and that volume, what we just talked about in the Netflix example. That's what I'm using to say when an industry group or a sector is actually moving into a sell signal. And I'm going to show you an example in just a second. And again, what does that come with? That comes with the volume. Big volume is what's going to control that. So let's take a look at this example. What's really interesting is I was pounding the table on energy. I absolutely loved energy. I was buying energy stocks, made good money on energy stocks, everything from Chevron to even fertilizer stocks like CF in my newsletter, all these different things. The first 6 months were unbelievable for the energy sector. Here's the problem though. The good news was we were in a great uptrend, but look at what just recently happened here. We got a 20-day closing low in the sector on June 16th. In addition to that, this is another thing that puts an exclamation point, is when we break major trend lines that mark the whole move of this stock higher. On the day that we got the 20-day closing low, we also broke a major trend line. In addition to that, look at what the up-down volume ratio was doing. After really nice movement higher, look at the breakdown we're seeing now. And look at what the up-down is actually, it is now, for the first time in a long time, the up-down volume ratio has now moved to distribution. So right now, it was a good run. That was 6 months. And I think that's one thing that we have to recognize in this type of market environment right now. If you get 6 months of an industry group, of a sector, that's a great run. And we did get some pretty exhausted prices here too. So right now for me, I am out of energy stocks. And until energy refreshes itself, which it may end up doing, we start getting accumulation coming back in here, and we start seeing my 5 factors start popping up on the other side. Right now, I am done with energy. Okay, and again, this is just proper risk management. This is just telling you, hey, it's over right now. It's over for a while. And again, everyone now is all big believers of energy, but as things roll along, you've got to let price tell you what to do. So again, this is not a time to be trying to buy energy stocks as they pull back. This is not a time to be going after them like that. They're down and out for a while. We'll see how long that takes. Maybe it only is going to last for 3 months or something like that. I don't know. But all I do know right now is Energy has given me a flat out sell signal, and risk management tells me it is no longer an area to be looking. Now, the next area, we're going to shift gears a little bit here. And what we're going to talk about is we're going to talk about how to calculate individual stock allocation or position sizes. And this again goes back to how I actually manage my portfolios as a portfolio manager, how I decided what kind of allocation I should be giving any individual stock that I put into my portfolio. This is extremely important. Now, again, these are the type of things that in a bull market, you're more forgiven for, buying, way more than you should of some certain position, and, over, going overboard on putting too much weight in any one position. And again, because the market is more forgiving. In this type of market environment, risk management from an idea of individual stock allocation is extremely important. And I want to go through my rules as far as how I determine this. And what's great about this, what's really neat, is in trading floor research, I've actually simplified this process. So once I get finished with this going through the process, I'll actually take you through how I've simplified it for my subscribers at Trading Floor Research. So the first thing that in kind of my pyramid here, the top of the pyramid, what I look at is are we in a risk on market or are we in a risk off market? So in other words, is this market, are we able by the indicators, and we're going to go through this in just a second, by the indicators, are we able to put more risk onto our individual positions, or should we be taking risk off? And every newsletter for I don't know how many months now, it's got to be since December, I've been calling this a risk off market, and I've been warning people that this is a risk off market. So what does that mean to our individual stock position right away? Well, when you think of a position as a full position of whatever that position might be, take 25% of it off right away, because we are risk off in this market. So that's number one. Then we come down to the next section of, is the market, is the S&P 500, is the NASDAQ, are these markets in a sell signal or are they in a buy signal? If they're in a sell signal, take that individual stock position that you've got there, and now we're chopping that 50% of what you should be putting on the table. Next down, industry group. Is the industry group in a buy signal or a sell signal? If you're buying in an industry group that's in a sell signal, take another 25%. Now we're only down to a quarter of what we should be putting on as a full position. And once we get down to the individual stock risks, that's where we're going to determine, are we actually at zero, or are we somewhere between 0 and 25% if all of these others are taken off the table? So let's move through this and I'll show you how I make those calls. And the first call, again, is risk on versus risk off, which again carries a 25% weighting on my individual stock positions. How do I determine risk on and risk off? I'm using the Russell 2000. Why am I using the Russell 2000? Because that is an index of small caps. What are small caps really? When the market is really focused on the small cap area of the market, that to me is always a signal people are willing to put more risk on. If you're willing to buy small caps and micro caps and things like that, that is pointing to a market where people are applying more risk. I'll tell you another measure though too that really I've looked at now too in recent years, as far as risk on and risk off, is looking at cryptocurrencies. Same type of idea. When cryptocurrencies are in a sell signal, this is clearly a risk-off market. And we could not be more risk-off right now in looking at cryptocurrencies too. I mean, they are just crumbling. And so again, whatever you're using, it always should be considered a very risky part of the market. And I've used it for years. I've used the Russell 2000 to mark that. And the last throw of risk on in this market actually drove us into March of 2021. At that point, the Russell 2000 gave a sell signal using the sell signal rules that I just went through with you. And we went into risk off for most of last year. So really, for most of last year, from March all the way into into October, we were in risk off, meaning there should have been no full position sizes even at that point. Now, again, that kind of hurt you a little bit if based on the indexes, and the indexes were moving up mostly because of the final large cap stocks. But if you were looking at the rest of the market already, a lot of the NASDAQ, 85% of the NASDAQ was already in a downtrend. And that was the same case with the Russell 2000 small caps. So really, when you were looking at a broader market anyway last year, we already had started this bear market. Now, there was a short window where I actually got risk on in the October going into the November period. And you actually saw one of the trades that comes to mind I talked about it in the last webinar, was Tesla. Bought Tesla for almost a 50% return in that quick period of time. That was risk on. That's when you could be putting those trades on with full force. And I took advantage of it at that time. But I will tell you what, from that time on, we have not gone to risk on. We have been risk off in this market, and we continue to be risk off in this market. So from that standpoint, 25% of any of my positions right now are off the table, right there. So now I'm down to 75% for any position that I'm going to put on right now. That's even if the market goes to a market buy signal. And really, it's kind of interesting. We're going to kind of run through this right now. What I pointed out in my newsletter about a week ago is actually it was it was 2 weeks ago that the market was set up at a number that I was looking at. Now, we are not in a market buy signal right now, but I believe that this market is ready to give us some good short-term relief. And why do I say that? Just real quickly, I'm going to run through this. This is a roadmap I put together for myself many, many years ago using Fibonacci numbers. And this has given me unbelievable market signals for many, many years as this market has gone on. And I calibrated my Fibonacci numbers to the 1987 crash. Now, I did this, and again, I started in 1989. So I was able to use this for many, many years as this market was moving and bouncing off of these major Fibonacci numbers. By the way, the top of the market in 2000 nailed the Fibonacci area I had earmarked. We came down to the low and we hit the low area of Fibonacci. Rallied back up in 2007. This was part of the reason I was moving to major cash in the end of 2007 going into 2008. We got the distribution and did not have any good reason until we had we actually hit my Fibonacci number in November. And that's when I actually put on for a short trade. Of course, we came back down into March of 2009 to close this thing out. And it closed against the Fibonacci numbers again. And you can see the way this thing, by the way, the red lines are 50% of the distance. 50% is always a big thing for me too. We're going to talk more about that today a little bit more too. But the red lines are 50% of the distance. Those mark very, very strategic points in this big map too. But where I want to take you to here is we rallied up to 50% of the range just before COVID hit. And when the market was already selling off, taking back 50% of the range, I was still a portfolio manager at the time. I actually took my positions off at that point and took the market down. Now, what was interesting though, and this is what I cited right here just recently, how this set up for this market move that we saw off of this Fibonacci number, 2395, we actually spent 2 days below that number. And my thought at the time was, because I know how powerful these numbers are, as soon as we close back above that number, I became a buyer of this market again. And it's very interesting that we actually spent 2 days below this number, and I'm going to blow up the map so that you can see that a little bit clearer. But we spent 2 days below this number. And I actually instructed, that's why I instructed and gave it in the newsletter. When we were below this number, I said, if we get a close back above 37.42, it led to a great buy signal here. And I believe it'll probably give us a pretty good little buy signal at this point. And sure enough, by last Friday, we bought the SPXLs and we were up about 11.5% going into Friday's close. I'm going to show you what happened at that point, what I also said in the newsletter last weekend. But before I go there, you're going to notice, look at what we did up here. This again was a big reason why I was recommending moving to a major cash position. We were getting distribution right at my 50% Fibonacci number between the major numbers right here. It missed it by less than a point that we topped out. And as we were topping out, we were getting distribution everywhere. We were getting sell signals. And it was, again, a pretty easy call. Why in my newsletter, I started cautioning with cash and caution. And but then we came down to this 37.42 area. Now, the one thing I'm going to point out to you, though, the big difference was between here and here. For me, the big difference was that this area at this time, we had a lot of great buy signals of industry groups that had clicked in just before this crash. And those buy signals of those industry groups held up even into the crash. We don't have the same situation. As a matter of fact, leading into this number, the last of our sectors, the energy sector, actually went into a sell signal. Now, I'm going to point out a couple of areas that are giving me a buy right now, and we're going to talk about those, but it's nowhere near where we were at this level down here. So do I expect some sort of a bounce? Yes, I do. Do I expect this? No, I do not. And so here is what we're looking at, just kind of blowing this up right here. Here's that 37.42 number that I was talking about. Here's the 2 days we spent below it. Once we closed above it, that became a buy signal for me for at least a trade. But here's the key, 50% again. You always know my 50% if you see my charts, because I always put them in red. Why do I put those in red? That's a war zone at 50%. What am I measuring 50% there? Of the most recent range from the high to the low on the S&P 500. I always want to know where 50% is. Why is that? Because if it trades above that range, the bulls are in control. If it trades below that range, the bears are in control. This is where the bulls and bears switch control. And this is where you're always going to see a major battle going on. And sure enough, what we do, and I reported this in last weekend's newsletter, we were up 11.5%. I said, look, we rallied right up into this 50% zone. Look for a pullback here. Now, I actually did not think the pullback was going to take us this low. I thought we'd be more in the 3,800, 38, 39 range and hold up there. Obviously, yesterday's close took us and closed us below that, which opened up this whole zone of between 37.72 and guess what? 37.42 again. If you look at the chart today, we spent a matter of about, I don't even know if it was 1 minute. It may have been 1 minute below 37.42 again. And we popped right out of it and we started to rally. And actually that rally in the early part of the day took us all the way back to even and a little above. And then they sold us off to the end of the day again and still held us above this Fibonacci number of 37.72. So again, for me, I still am looking at a probability that we could even get as high as 4,000 in the short term on this thing. We'll see where we go with this. But the whole thing that's going to change it for me, and I'm going to tell you, it's not a good sign at all. And again, here we go back to risk management now. The risk management part of this trade is, if this market turns around at any point in time and we get consistent closings below 37.42 again, this is going to set it up that this market is really going to start heading into a tailspin. So I have to tell you, 37.42 is very, very big. Now, eventually, I do expect us to take this out. And this is a number, as far as risk management, though, goes. If you have any kind of long positions that you took at the right time, this risk management tells you at that point, a close below 37.42, I'm going to be pulling those positions off. And again, the whole idea here is if you're getting in at a certain price, you better be ready to go why you knew you got in. Risk management is what tells you the proper price to get out on the other side. Now, on the opposite side of things, though, I'll tell you an area that is incredibly bullish right now for whatever reason. And again, I'm just using price analysis to tell me this. So when we look at markets right now, one market is actually giving me an out and out buy signal, and that is the Chinese market right now. I'm getting, I got my price buy signal. I got, well, associated with my volume. We broke my trend line, and actually today we threw back into the trend line. And by the way, the other thing, and we're going to talk about both of these points here today, because this is what I call low risk entry trades, is where when you get your buy signals and you throw back into a trend line. Everyone understand hopefully what I mean by a throwback. When you have an established trend line, by the way, this trend line goes to the top of the Chinese market that was put in, and we broke that trend line. And we threw back into that trend line. So we retested that trend line, but we also did it at a pretty strategic point too, where it allowed the 10-day moving average, which is a big thing for me. Again, measuring risk to allow that 10-day moving average to catch up to price, because this is, I'm going to say this maybe even a couple times today, because this is really important. The strongest of strongest stocks are always going to pull back to the 10-day moving average. The strongest of indexes, the strongest of anything, is minimum going to pull back to the 10-day moving average. And that's what we actually saw today. So this is going to open up, or it allows you then, by waiting for that trade, instead of buying when you're extended, waiting for that trade to come back in. And again, this is about risk. This is about buying at a low risk entry. Now, let's take that into the industry groups and talk about leaders and laggards in the industry groups. Why? 25% of my position size of an individual stock is going to be based on whether the industry group is in a buy signal or a sell signal. And here's what's kind of interesting. We just talked about the Chinese market, the Chinese index. Let's take a look at a Chinese industry group marked by an ETF. I actually put this ETF as a conditional buy. We're watching it still. And today it finally got down to my number that I was looking for. I put in the newsletter over the weekend. It finally pulled back to my 3173 today. We finally got the pullback, a beautiful throwback into the trend line. And now all we're waiting for on this is 30-minute confirmation. But look at this. You had a beautiful cup with a handle base, broke out of it, gave you all the buy signals. By the way, look at your up-down volume ratio on this is 1.75. This industry group is strong. So let's break this down. What are we looking at here for China? We're looking at our market is in a buy signal. We've got an industry group in a buy signal. And we're going to talk about a stock today that I actually put in the newsletter that I was adding to the position today. The stock did very well in this horrible market today, and it's part of the Chinese internet industry group. So we're going to talk about that today. But again, this is all part of risk management, understanding these type of things. Here's another industry group that just recently gave me a buy signal. This, and I wrote that this was very surprising in last weekend's newsletter. This was last Friday. It actually gave me a buy signal with the volume, broke the trend line, and that is biotechs. I'm getting a pure out and out buy signal. Look at yesterday's volume coming into biotechs. Today, the group acted beautifully. It came down. I didn't put that on here today, but you're getting the bow tie in the moving averages, came down and tested with a tail the 10-day moving average and ended up closing at the high end of the range. And in addition to that, look at your up-down volume. It is taking off. Accumulation is coming into this area massively. So here we do have an industry group to look at. So in this particular case, though, when we talk about US markets, we've got, we're in risk off. Even though this is a risky part of the market, we are in risk off, and we also are in a market sell signal. We are in a biotech buy signal, so that opens us up, and the individual stocks that I'm going to be posting in the newsletter here coming up in biotechs, we're going to be able to take at least, depending on the stock, we may be able to take a half position size on this kind of stuff, okay? Solar, another area, just gave a buy signal, threw back into the trend line, threw back again into the trend line. This keeps throwing back into the trend line. A great buy signal in solar. One problem I have, accumulation could be a little bit better. So right now, I'm not seeing an overabundance of accumulation, but it's enough that I'm actually looking at, and I actually put in the newsletter, DACO, New Energy Corp. And today, I actually advised to add to the position today in this horrible market. But this slide was put in a few days ago when we're going to talk about this. What I wanted to focus on this stock, and I'm going to use this in just a little bit, was the idea that looking at a 10-day moving average, looking at where we were on Fibonacci numbers, we were needing to pull back on this. And again, that's exactly what the stock did. And it did it in a very, very good way. Look at the up-down volume ratio. This is skying on this thing. We are seeing massive accumulation in this stock right now. So what do we have here? We've got an industry. This is really incredible. We've got an industry group that is in a buy signal, the solar stocks, but guess what this stock is? This is a Chinese stock. So now we've got the Chinese market with this stock, and we've got the solar industry group, and we've got what I think is the leadership stock in this industry group right now is DQ. And here's the bottom line. It's so good that once the stock set up properly and gave us our proper pullback in this horrible market today, I was advising newsletter subscribers to actually add to their position today. Why? Because risk management said it was the right thing to do. All the procedures were telling me in position size that this was a very good place to increase your position, okay? So let's break it down now. Now we're finally getting to the individual stock area when we're talking about position size. Here's the areas that I focus on with the individual stock. And I just ran through some of these already. 10-day moving average, average true range. We're going to talk about this. Fibonacci target numbers. Are we trading above the Fibonacci number? Are we trading below the Fibonacci number? Where's the lower Fibonacci target number? All of these things are part of how I assess the risk of where this stock is trading right now. The other thing is, we talked about this, is the trend line throwback. That's where we get the real low risk entry when we're entering this position. And depending on what I'm seeing in these different factors, this is what's going to measure whether this individual is stock percentage is going to be closer to 0 or it's going to be closer to the maximum 25% for this individual stock. So when I talk about average true range, there's, as a portfolio manager, this was a really big tool that I used. And why did I use that? Because average true range for any individual stock that you're looking at gives you a very good sense of the volatility of that stock. Thus, if you know the volatility of this stock, you have a very good, you can assess risk of that stock. Where are we with risk parameters of that stock? And so what is average true range really measuring? It's really the range over a specified period of time. Is you're averaging the ranges, the daily ranges. The formula says you're taking the high and low of the daily range, and then you're just averaging it over a certain period of time. Now, most people use 14 days of trading days. Again, keeping with my consistency of what I do, I use 20 days. So in using average true range, I'm looking over a period of 20 days. And again, what am I doing here? I'm measuring the volatility of this thing. And by getting a better sense of volatility, I get a better sense of the risk of that stock. Let's take this DQ again. Here's the problem with DQ. And I'm going to show you an example of another Chinese stock that I also recommended adding to today. The reason that it's not near a full position, even after adding to it today, it is not near a full position, is because the average true range is up near the highs of where it's been trading. Now, if what I'm ideally looking for, if I'm buying a setup in here, I want to see my average true range more towards the low of the ranges, of the recent ranges. When we're up towards the high, what is that telling me right now? That's telling me we've had some pretty big expansion days. And what that's telling me is there's greater risk in those shares. So again, I'm going to take the trade. It's not a matter of not taking the trade. The idea here is, how much am I willing to risk on the trade? Because I understand I'm looking at this trade for what it is. And there's a lot of good in this trade. And that's why I want to take it. But I do have to understand the risk. And I don't have a bull market that's going to save me from making bad risk decisions. So this is what helps me. And again, even as a portfolio manager where risk was an essential part of what I was doing, this is guiding me towards, okay, I'm going to take this trade, but I'm definitely not taking the full position of this trade because of that higher elevated risk. As I look at the trade develop, though, this slide was put in before we actually got the pullback. And what I was looking for with this was I was looking for a pullback that could have gotten us back down to 62.41, down to my Fibonacci number. We actually got very close to that yesterday. And with that, we also got a throwback into the trend line. But here's the other thing to recognize. When we were up at this level, number one, we were trading below a major Fibonacci area, 68.87. All right, that was Fibonacci resistance at the time. Where we wanted to see, we wanted to come down and see if we could properly retest that Fibonacci support. Also, as it was developing, look at where our 10-day moving average was. We were quite extended from the 10-day. Again, what do most stocks do? most stocks, your strongest stocks, are going to find their way back to the 10-day moving average. And as we move ahead on this trade, hang on here. Oh, let me see. Hopefully I put the slide. Might be out of order. Oh, interesting. I thought I put the slide in here where Daeku actually ended up going yesterday. It actually ended up pulling back to this area and then going up. And today, again, like I said, it pulled up enough that it gave me 30-minute confirmation and actually ability to actually buy more shares even today in this horrible market environment. The next trade, though, I wanted to show you was another trade, another Chinese name that I put in the newsletter just recently, and we added to this position today. Now, I clipped this slide earlier in the day when we were just getting another confirmed signal. An interesting thing to point out, by the end of the day, even in this horrible market, we closed above the 775 Fibonacci resistance area today. We closed at about 777 or 778 by the close. Very important stuff. But look at what we did. In doing this, we got a pullback into the trend line. We actually, and here's a very important thing we did. This actually is a 7/8 number. When things will hold up on my 7/8 number like this did, that oftentimes can lead to explosive moves. So I would watch this stock. This could end up being a very, very nice stock and move up very sharply here if this market gives relief. But what I want to point out with this also is, look at my average true range at this point. Here was my high point of average true range in this area. This is where we had a lot of expansion. Look at where risk is at right now. This allowed me to add to that position today, increase the position size. And again, it's a good trade, but the risk level of this trade is a lot lower than the DQ risk level. I know that because of my average true range. Oh, the other interesting thing about this trade too is that Chin Data is actually an internet in the internet network solutions industry group, which again is under the internet industry group that I pointed out, K-Web, earlier. So we've got a buy signal again in the Chinese market. We've got a buy signal in the internet industry group, and sure enough, we've got a leadership stock in that industry group. So what is that going to do to my portfolio allocation on this? This is going to be able to I can properly raise that allocation, which, like I said, today, that's what I actually did. So after we got this pullback, and here's Chin Data again. By the way, look at my up-down volume ratio on this, 2.51. This is under massive accumulation. We get the proper sell-off signal, and in my newsletter, I right away show you where my target numbers are on this for upside targets. And I keep you advised on that as far as my, when they hit those targets, I let you know with a text. Again, just to review this is what I was looking at. How extended were we from the 10-day moving average? Were we buying below or above the Fibonacci target numbers? Where were we on trend line throwback? This is all what I put in to calculate individual stock allocation. Now, oh, here's the Daeku trade. I threw it in over here. I don't know how it got put over in this area, but let's take a look at it. So here we are, throwback into the trend line. This was yesterday. Look at this also. There's your 10-day moving average. Catches up with the 10-day moving average with the throwback. And then, again, you were basing below the fib, but you came and retested the fib area, and actually you held up even at the close of the day above my 66.83. By the close of today, you took back this major Fibonacci number of 68.87. I forgot exactly where you closed, but I think you closed somewhere around 71 today. So again, had a very nice close. And here's my targets I'm looking at on Daku at this point. Oh, and again, there's your up-down volume ratio, just skying as this thing is moving ahead. You're getting great volume coming in this. So again, this is what we looked at. We broke this thing down from an area of market, risk on versus risk off. Is your market in a buy or a sell? Is your industry group in a buy or a sell? And is your individual stock? What is your individual stock risk? This is all what decides my position size. And again, as I was a portfolio manager, and also I'm using that right now in making the decision of what allocation am I telling my subscribers to do. But I make this very simple in my newsletter. Here's the way I break it down for you. So when I take and put this all together for you, I'm breaking it down in a simple 5-star system for you. So based on all of those parameters, everything I ran through for you, the top position for me is going to be a 10% position. 10% of my portfolio would be allocated in any one individual stock. That would be given a 5-star rating. 4 stars would be 8%. 3-star 6, 2-star 4, 1-star 2, and I even give half stars now, which would be a 1% position. And again, I can come back like I did today. I initiated those those Chinese stock positions, and today I increased the position size on both of those. And I let you know that. Why did I increase those? Well, because they gave me a new confirmation, but they gave me a new confirmation in the context of risk management of the market, of the group, and of the individual stock allowed me to increase the position size of that and report that to you. So let me break it down for an example for you. So in other words, if you've got a $100,000 trading account, a 5-star stock would mean you would be putting in $10,000 of that $100,000 position. A 4-star would be $8,000, and a 1-star would be $2,000. That's basically what my simplified of everything I just ran through for you in breaking it down in a simplified 5-star system. That's what I'm giving you actually in the newsletter for proper risk management, portfolio allocation of your position. So finally, what I want to run through for you is I want to kind of bring a lot of these ideas together and talk about, we're going to run through a stock here that I recently, just in the beginning of this week, I put it into the newsletter. I put a newsletter out on it. We have not confirmed the position of this yet because we were waiting for a market pullback on this, which is still happening even today. So we're getting closer, but we'll run through this for you. But what we're going to run through here again is I'm going to emphasize the idea of market drawdowns and methods for cutting losses. But in addition to that, when you're buying on the buying side. So we're going to run through one stock where we're going to go through the cutting of losses all the way to now this stock actually giving us buy signals. And that stock actually, believe it or not, is Zoom Video. And Zoom Video, I'm taking you way back here when Zoom Video was topping out, when it almost hit my Fibonacci target number of 606. And sometimes what's going to happen, instead of hitting that final target number, I love drawing these trend lines above price. Once you get these spike ups in price like this, draw trend lines above it. You will be surprised at how many times price will come up and it will tap that trend line. A lot of times it happens a lot closer to the Fibonacci number, but in this particular case, it was a little shy of the Fibonacci target number, but nevertheless gave you a very good indication when this stock was topping out. Because the other thing you could be doing at that time, I'm going to show you in just a second, is this stock was also starting to move into distribution at that point. And so volume was already in this last market surge. This last market surge to me was a lot of short covering and a lot of last minute money pouring into this Zoom video because the big money was already exiting the trade. And what did we do right here? This is a big factor for me. We broke the trend line. Breaking a trend line after a massive run, you take it from the beginning of that run, you break the trend line, and that's breaking the back of this trade. And it's very, very hard for a trade like that to recover. But what happened one day later? A 20-day closing low. So here we are, breaking the trend line of the trade after hitting a top marked by the trend line, almost at my Fibonacci target. And what did we do? 20-day closing low. What did we do after that? Well, they traded it down to the 50-day moving average. And guess what? Institutions came in and supported it at the 50-day. This was money. A lot of institution portfolio managers, and I can tell you this because I work with a lot of them. There is one rule. They don't look at a lot of technical analysis, as I pointed out earlier, but there is one rule that the traders are instructed to do. And that is when price hits the 50-day moving average, if they love a stock, they instruct their traders to buy on the 50-day. So what did you get? One last bounce off that 50-day moving average. Your moving averages already started to bow tie to the downside. My three moving averages, 10, 20, and 30, I talked about that in my first webinar. They bow tied to the downside. And guess what? Then you get a gap below the 50-day. The best it could do at that point was rally back to the 50-day. And by the way, where it broke down from the sell signal, you got to rally back to that 50-day. And what were the institutions doing now? They weren't instructed to buy anymore. They were instructed to sell. And sure enough, we even get a gap down sell. And again, the rest is history. This gave a great shorting opportunity right in this area. It was coming down. Look at how it kept messing around with the 50-day. They took it above, took it below the Fibonacci number, broke the trend line, threw back into the trend line, and crossed back below that Fibonacci number. I used that as a great shorting opportunity right there. So then this stock just became a great short, which again, we topped out at, I forgot what the number was, high 500s on this thing. We topped out, and our low was not put into this thing until just recently. I'm not even showing it on this slide. At around 79, I think, was our low on this stock. But here's the point I want to bring out. Remember what I was saying when we were in the last throes of this exhaustion rally here, and we broke that trend line. Look at what up-down volume ratio was saying about what volume was doing, what sellers distribution was doing. It already had broken the 20-day low and actually even moved into distribution at that point. So we were under this whole time then, since then, this stock has been under distribution. But look at this. This was as the stock was making its last high. So again, once this thing cracked and gave you that 20-day low, it was already over. In risk management terms, you should have been taking that trade and moving out of that stock at that time. Here's as it progressed on, and again, like I said, just recently the stock even hit a low of around 79 or so. But in doing that, look at what started happening to accumulation on this stock. This stock is under some pretty massive accumulation lately. And in addition to that, look at the nice little base this is starting to put in. You've got a nice little cup and handle. You've broken the trend line, gave a fantastic buy signal. What I was waiting for was a pullback after that buy signal. Letting the 10-day, again, these are all risk things to be watching. Letting that 10-day catch up, pulling back in. We closed right around 108 here today. We tailed down. I think we got as low as 105. We still have not gotten the confirmation of this trade that comes to you with a text. I still have not sent out confirmation to the subscribers on this, but it's setting up still perfectly for the trade. So we'll see where this one goes to right now. But that's Zoom. That's what I'm seeing. Take a look at this. Look at your average true range. Look at where your average true range is on this now. I mean, your risk on this trade is very, very low. This has tightened up. Not a lot of volatility left on this trade anymore as you're starting to emerge. This is exactly what you want to see as you're buying this. Oh, I guess I did include, this was yesterday. So yesterday we pulled down to here. I just didn't include today's trade. So here's where we are currently. And today we actually tailed off and pulled back a little further as we're throwing back into this trend line and setting up the trade. But that's, oh, and one last slide on this. Again, here's your up-down volume ratio as this trade is progressing. Looking fantastic at this point. And that's pretty much all I had for you today. Again, Dave Wozniak, Chief Market Strategist with Trading Floor Research.